where we had some record closes for the Dow and the S&P 500. Joining us now is Michelle Schneider, who is the partner and director of trading research and education for MarketGauge.com. Michelle, great to have you back here with us today. More record closes on Wall Street today. I'm sounding like a broken record every time we check in, essentially. So what are your biggest takeaways from today's session?
Well, since we're on records and songs, all I keep hearing in my head is Pharrell Williams' Happy, because that's how the market ended. And it's a great way to end the week. Certainly people's 401ks are happy, especially if they're in mega cap stocks, which were the big news of the week. Making that huge comeback, Microsoft having a breakaway gap open on Thursday with the follow-through today, NASDAQ on its way to 340. Even the Russells, which were lagging, got a little bit green here at the end, which is good because they cleared the 50-day moving average. So it seems like we're in good shape heading into next week, barring anything unforeseen.
So what do you believe to be the biggest catalyst over the course of this week?
I think there are three. I think the market started out happy, to use the word again, after the jobs report that we saw a week ago. I think the Fed being accommodative also really helped. They came out and sort of soothed the market, even though the short-term yields rose a little bit again. And I think the expectations as we're going into the next earnings season are pretty good for a lot, especially tech stocks. So we saw rotation out of some of the places that had been leading, like electric vehicles and solar energy, and the whole energy space actually relaxed a little bit. But this move into tech was really the theme.
And so with this particular move and what we've been watching notably play out in Washington, D.C. as well in infrastructure proposals, where do you expect that to continue to be a focus for the markets, and where might they continue to either find some type of full steam ahead mentality, or where do you think we may see a little bit of a pullback, or would pullback be more tied to some technical performance, something underlying that we're not seeing right now?
Well, there's three areas I think the market is watching for. One is Biden used the word compromise this week. So where's the compromise going to come? If it comes in the form of how high corporate taxes go, I think the market will be relieved about that. People are suggesting more like 24 to 25% as opposed to 28%. And with the rates down here at these levels, certainly the corporations can handle that before they have to make any kind of cutbacks. As far as the infrastructure package in terms of how much it's actually going to spend and how much money will actually be earmarked towards real infrastructure remains to be seen. That will be another area of compromise. But at this point right now, if you just look at the pure price action, the infrastructure-related sectors pulled back a little bit and didn't close as strong as the big tech, but certainly no one can really complain about their performance. As I said, transportation in the very beginning, if we just look at that, IYT has played a little bit of catch-up here at the end of the day on Friday, and the Russell small caps, which will be impacted, also managed to eke out over. So you've got the market optimistic on one level with the tech, and then somewhat optimistic here with the more inside sectors of the economy, market sectors of the economy.
With so many new retail investors that are certainly a part of this activity that we've seen over the past couple of months, where would you be suggesting that they draw their attention towards, especially given some of the big names that were part of the Reddit-fueled frenzy in prior months? They're kind of falling out of favor, it seems.
Well, I've been really interested in the banks right here for two reasons. One is just the traditional idea of the banks coming back as the economy comes back, along with the fact that with the yields tightening up a little bit, that's actually good for the banks. But there's also a huge wave going on in the banks right now related to cryptocurrency, as a lot of the banks have special divisions for that. And also with the dividends being able to be raised, which was announced by Yellen about a few weeks ago, and earnings season coming up, I think the banks would be a really good place to go. And we have skin in that game, so I'm speaking somewhat the position. As far as what else, one thing we didn't talk about is the PPI came out today with inflation expectations higher than what people presumed ahead of that, which of course means people that are using the standard metrics excluding food. So going back to what that means, I think you have to have that inflation idea in the back of your mind and play some of the inflationary indicators. And two of the places that have been so undervalued still are gold and silver. And there are so many bears out there. I think gold has actually held up pretty well, all things considered, after reaching a bottom. And also food-related commodities, which also go completely unnoticed, but they've rocketed with corn, for example, making a new yearly high today. So there's a lot of places to look. I mean, yes, you can get into big tech, but now that they're pretty extended, you have to worry about valuations, again, with earnings coming up. And I still think that we're looking at cannabis, which has been also undervalued. I still think the whole EV space will come back, and especially grid technology, because we have to fuel those cars. So there's going to be lots and lots of places to look. You don't have to get running into Microsoft here now that it's trading at 355 or 255.
You know, it's truly interesting because right now we're seeing the vaccine rollout take off. You've got the economy continuing to reopen. The economy, though, it could sputter once this wave of momentum subsides. A reporter that I hold in high regard, I think, posed a good question over the course of this weekend. Does anybody know what date the pandemic ends? Like, how will we know? Will there be a dove that comes back with an olive branch or something like that? Is there a specific date that we should be marking off? Because everybody's talking about pent-up demand, but exactly with, investors already trying to factor that into the best ability possible. All right, at what point does some of that pent-up demand start to either already have been factored in or start to subside?
I couldn't agree with you more, Brad. I think that's a huge question. And you say we, as in the United States. We know that Europe is not nearly as in good a shape as we are in. And of course, they're always talking variant. There's constant things that can be scary about this going forward. But that's why I've been thinking more, inflation is the word people are using, but I keep having this nagging stagflation word going through my head. Because once we do come back, whatever that looks like from here, where is the economy really going to grow? And all hopes on this infrastructure package makes me a little bit wary about seeing GDP way past 3.5% if we take out everything that happened during the pandemic, where it was before that. Can we get to 4% and beyond? We'll see. Meanwhile, these commodity prices and all these essentials, copper, steel, lumber, keep going up. Food keeps going up. So at what point does that become a factor? And the yields have to rise because the Fed has to do something to control it.
Michelle, always a great take, insight, and perspective that you're able to provide. Michelle Schneider, who is a partner and director of trading research and education for MarketGauge.com. Appreciate the time as always. Have a great weekend as well. Want to toss things